Yes, there are mistakes we all make while investing, mistakes that are related to the way our brain is wired, the way we think, we interpret reality, and limitations in our own thoughts. Many times we think we are being rational, but our minds are breaking things into smaller, bite-sized choices we can consider individually, forgetting to frame our decision, considering the broader picture. We all tend to be risk averse when facing gains and tend to be risk seeking when facing losses. And this combination of how we think might lead us to make decisions that seem to be optimal at the individual level, but in reality are far from logical or optimal when we think about the broader picture, when we consider it. Decisions that can actually make investing and trading unprofitable in the long run, or at least less profitable, and cost you really a lot of money. In this video, we explain you what are these common mistakes and how you can avoid them. Yeah, fortunately, there's hope to avoid these mistakes, but you first need to be aware of them. And instead of wasting time explaining you what they are, let's start with an exercise that will help you understand what I mean. Imagine that you face the following choices. You can see here the pair of decisions that you'll have to take around the same time. You have the first decision, that is to choose between a sure gain of $240 or a gamble, a 25% chance of earning $1,000 and a 75% chance of gaining nothing. And then you have the second decision, to choose between a sure loss of $750 or 75% chance to lose $1,000 and 25% chance to lose nothing. Now, please don't just continue the video, stop it here. Leave me a like below if you can while you're there, while you're stopping the video, and reflect on what would be your decision for both of these choices. Do you have your decisions already? If not, please pause the video again and continue thinking about it. But if you do have your decision decided already made, let's continue. If you're anything like most people, you like the sure option in the first decision, the option A, and you like option D for the last decision. Considering the expected value of option B, that is $250, you're actually willing to pay a $10 premium for the certainty of winning $240 and for avoiding the gamble. And on option D, the expected loss is $750, so very similarly, but you do prefer to take on the risk instead of locking in the sure option. From studies carried in this area, we've seen that around 73% of people actually choose option A and option D. And if you choose option A when facing gains, you are clearly risk averse. You prefer to lock in sure gains, and you're actually willing to pay a premium for that. If you choose option D, of course, you're doing an opposite behavior. You're being risk-seeking when facing losses, because you are willing to lose more to have a chance of not losing at all. This could be seen as a limitation, right? Because you're decreasing your potential of gain by locking in your gains earlier at the lower price to be sure that you actually make gains. But when you're facing losses, you're actually being risk-seeking, meaning that you can face much greater losses. And if you combine smaller gains with higher losses, you can kind of see where this moves towards in the long run if you follow this kind of decision very often. However, this is not the only limitation we face. You've actually came to your decisions, you've made your choice by considering one problem at a time, even though you knew that you're facing the two decisions at the same time, and the logic would tell you to consider these decisions together. And what do I mean by that? Is to actually compute the probability of these decisions together as the combinations of decisions, right? So combine A and C, combine A and D, combine B and C, and of course combine B and D, and see what are the outcomes and the probabilities. But of course, this is much more work. It's much harder to our brains because it's not the way we are wired to think. and we have to consider different variables and consider much more in our decisions. However, if you want to optimize for results, that is what you should be doing, but what we usually fail to do. And why am I saying that this is what we should be doing, and why am I saying that this is the optimal? Well, because let's try to do it ourselves. If you choose between A and D and you see the combined probability of these results, you'll come to the conclusion that you have a 25% chance to win $240 and a 75% chance to lose $760. However, if you choose B and C, you have a 25% chance to win $250 and a 75% chance to lose $750. So clearly, B and C is a superior choice at all levels when compared to A and D, especially if you have to do these choices together. And A and D, as you've seen by the metrics and as you've probably chose as well, it's the choice we would get to if we consider these problems together instead of combining them, right? Combining these decisions together. So can you see what this might mean to your investments when you're making investment decisions? Are you considering the broader picture, or are you making decisions thinking about your portfolio as a whole, or thinking about each investment individually? And the reality is, many times we don't think of the portfolio as a whole, of all the decisions together, but we think of them individually. And picking up on the same study, are you aware of the number of people that actually choose B and C? Only 3% of the people participating in this study has chosen this option. So it's crazy, right? Could you imagine that actually considering the choices individually would actually lead to choose a less profitable combination of choices than if you mix everything together? It's probably something we don't think of until someone tells us this, until someone makes us aware of these limitations in our judgment. The reality is that this kind of broader view of combining decisions and framing the decisions always delivers a superior result, or at least a result that is equal, not inferior, to the results of considering choices individually. Of course, with two options, this is easy. However, if you have, for example, 5 yes or no decisions to make, you have actually 32 possible scenarios to consider. So the more choices and the more variables you have to consider, the harder it is for our brain to make decisions considering all the variables, which is a limitation of how we actually think, right? And as we can see, and for better outcomes, we should definitely follow this broader approach to consider the portfolio and consider our expectations of gains and losses, and consider how independent we think each stock, each crypto actually is in our portfolio, instead of actually considering individual cryptocurrencies and individual positions. However, unfortunately, this is not our only limitation. We do have a propensity to keep mental accounts of the prices of individual cryptocurrencies we invest in, and we do tend to have as well emotional reactions to these mental accounts. For example, if you look right now at your portfolio, you probably kept track of the price at which you bought your cryptocurrency to evaluate the performance, and even for purposes of taxation to guide your decision, right? And these accounts are extremely useful, not only to track the growth of your portfolio, but also for yourself to control your expenses, and that's all good, of course. We do this to keep things manageable. We do this to keep things understandable for our mind, and to help us feel that we have enough information to make more logical, more correct decisions. But sometimes it's exactly the other way around, because let's imagine that you, for example, have to pay for a new car and you have to sell some crypto from your portfolio. You look at your portfolio and you basically start by identifying the winners and the losers from the cryptocurrencies you have. Although while making this video there are more losers than winners, let's just imagine for the sake of this exercise that Cardano is a winner and Zilliqa is a loser. If you sell Cardano, you will actually lock in a profit of $5,000, but if you sell Zilliqa, you lock in a loss of $5,000. If both cryptos have been kind of stable in the last week, the question is, which one do you prefer to sell? Well, most of us will be inclined to take profits, to sell Cardano, to lock in a gain, to lock in a profit, to add a positive investment to our track record as investors, right? And we might even think that Cardano has already appreciated in price, so it's unlikely to appreciate more because of that, while Zilliqa has a lot of space to appreciate as it only went down instead of up, without us really having any considerable evidence for this way of thinking, for this thought, besides the previous price action of these tokens. So as such, we convince ourselves that it's better to take profits and take our chances in Zilliqa, who might still be due for an appreciation. But do you see any similarities to the previous exercise where we are willing to be risk averse when facing gains, and we are willing to be risk seeking when facing losses? This is because if you think about it, selling Zilliqa also means admitting failure, means taking a loss. And as we've seen before, it's something we try to avoid at all costs, and we are even willing to take more risks to avoid such losses. And if we frame the decision like this, selling Cardano will be a win. It will give us pleasure, it will make us feel good, while selling Zilliqa will be a loss and cause us pain. So the emotion will also play a role, and with that, we'll always choose to sell Cardano. And finance research has actually confirmed that people have a massive preference for selling winners rather than selling losers. These accounts can be useful to keep track of our portfolio, but the reality is when we have these mental accounts for each of our cryptocurrencies, we have an irrational desire to be able to close all your positions in green. Yeah, we know it's human. We all have that desire. We want all of them to generate gains. However, if we take a broader perspective, if we are a little bit rational, we know that it's not rational, and we should not expect to have everything as winners. We should expect to have winners and losers, because after all, it's very hard to get everything right, and we'll make bad decisions, we'll choose bad cryptos. That means that, once again, we are better off taking a broader perspective, considering our portfolio as a whole, while keeping ourselves from giving too much importance to the individual performance of each cryptocurrency, and not look so much at their losses. They've already lost them. It's a sunk cost, so it shouldn't matter for our decision. What matters is moving forward, what we believe is going to happen. So, as an investor, whenever you need to sell or are thinking about selling, you need to make a decision on which cryptocurrency you should actually be selling. You need to make an impartial evaluation backed by data, from fundamentals, from technical analysis of which cryptocurrency do you think has the highest potential for price appreciation in the future, regardless of its previous price, and sell the ones with the lowest potential, regardless of whether it is a winner or a loser. And of course, you should also consider in this decision that is well documented that cryptos and stocks that gain in value are more likely to keep this kind of price performance at least for a short period of time. So winners are more likely to keep on winning than losers to reverse the trend, right? The trend is usually your friend until you have some really serious reasons to change it up. But more than that, as a rational human being, and in countries such as the US, you also need to consider that selling a crypto that is losing, actually reduces your tax. After all, tax advantages are available all year, not just at the end of the year. So definitely you should consider that in your decision, because that's super attractive. Hopefully keeping these principles in mind, being aware of your attitude towards gain and your attitude towards losses, practicing this art of having a broader view of things, considering more variables, and being less emotional with your crypto portfolio, you'll be able to make better choices that will increase your potential for profits in the future. Of course, you need to be careful about selling winners, because while it's good to take profits, as we usually say in crypto, it might mean that you end up just holding the poor performing cryptos. Cryptos that will never do as good as you expect, that will keep on going down in the long run, and you'll just be constantly doubling down on your losses by having these cryptos into your portfolio, and that will remove the profitability of your future wins, right? So sometimes it's better to be able to sell these cryptos, sell these losses earlier, and at least retrieve the majority of your value before this crypto goes lower, than to just hold it because you think maybe in the future it can increase, but it's possible it might not increase as much as you need, or it might never return to the price to which you bought it for. So as a rational investor, what you want is to double down on your good picks and sell the ones that have not performed how you expected and that turned out to be bad picks. So a constant evaluation of what seems to be the potential of each crypto is really important, because it's really important to keep adjusting and readjusting your portfolio as time goes by. And please try to leave those emotions out. Try to not be thinking of gains and losses, but think of the best way to grow your overall portfolio, because if your overall portfolio grows, that's what matters. That's a gain. That's what you need to try to maximize, and not individual crypto pickings, right? So if you're eager to put this into practice, to learn a little more, why not check this video here, where we have some of the best crypto gaming projects developing on Cardano, the ones that seem to have the most potential for the next bull run. And this way you can actually try to go through the process of assessing each one of these projects, but also accessing the ones that have a most potential and are a better fit for your own portfolio, right? So on my side, I'll see you there.